days after its announcement, Kenya's government still continues to try and make the case for its decision to reduce its stake in the most profitable company in the region, Safaricom, to a very, very skeptical public. Now, to recap the terms of the deal, Vodafone, through its South African unit Vodacom, will essentially be paying the Kenyan government about 26 US cents per share to acquire just over 6 billion shares in Safaricom. In addition to that, it will be making a one-time payment of $310.7 million in lieu of future dividends that the Kenyan government will be entitled to through its smaller 20% stake in the business. There's no time limit in place for the repayment of those dividend purchase rights, as a full repayment, of course, will ultimately depend on the performance of Safaricom's businesses in Kenya and Ethiopia. When the deal was announced, the finance minister, Mbadi, argued it was necessary in order to raise the cash needed to invest in infrastructure like roads, power plants, water treatment plants, without raising new debt.
This partial 15% divestiture will generate approximately 240.5 billion shillings in aggregate proceeds. It is important to note, and I emphasize that this transaction has gained us a 23.6% premium on the 6-month volume weighted average price. Once complete, the funds from this transaction will be the seed capital for the National Infrastructure Fund and the Sovereign Wealth Fund, which we have previously talked about. I urge Parliament, and more particularly National Assembly, to expedite the approval of the instruments required to establish the two funds, ensuring they are operational by the time the transfer occurs. I will also emphasize at this stage that this is the first step in the government's vision to allocate resources into critical infrastructure investment priorities, specifically energy, roads, water, airports, etc., without subjecting Kenya to more debts and without raising or hiking taxes.
Now, it's important to point this out. This is not the first time that the Kenyan government has been talking about setting up a sovereign wealth fund. In fact, the last time we covered this topic on the program was in 2014. And in the decade since then, Kenya's government has run high fiscal deficits, over 7% in some years. The country is now at high risk of debt distress, and there are no large revenue inflows on the horizon from commodities. So is there really an economic argument, a sensible one, for setting up a sovereign wealth fund? I put that question to the CEO of the Kenyan Institute of Economic Affairs, Kwame Owino.
But if you think about all the logic that comes with a sovereign wealth fund, Kenya doesn't meet any one of them. So first, they're usually countries with a huge, or rather a stabilization fund. So you're trying to establish a stabilization fund because if you have commodities, the prices fluctuate quite a bit. So obviously that provides. We don't have, commodities do not even constitute, exports do not even constitute 1% of GDP. So the countries that tend to have them have something like sometimes as much as 20, even 30, because you have very, very huge volumes. So that's one. Two, these countries tend to have surpluses on the budget side. Yes. So you have a reason for saving. And therefore you have a reason to save for whatever reason you decide then to have a sovereign wealth fund.
And it also helps with managing the currency, doesn't it? Because if you have this big slug of foreign currency income coming in at one go,
of course,
your currency appreciates, which doesn't exactly help you.
Yeah, it doesn't help. So of course that's part of the, yes, to avoid the Dutch disease and the ability, I mean, that one. So that's basically thing. So if you have surpluses in trade or you have surpluses in income, then obviously it makes sense. And if you have budget surpluses as well, then that makes sense. So in Kenya's case, all three are not met, especially because some of the simulations I've seen are talking about, look, we might get as much as 10%. That will be promising too much. But if you're borrowing at, net borrowing is 14%, then, I mean, there's no gain specifically. So I think that the logic of it on the economic side, there's completely no justification for this. In addition to the fact that, of course, you introduce governance problems in the management of sovereign wealth funds.
When you're talking about governance problems, because the argument that I often hear, especially with respect to how the Kenyan government runs its finances, is if you've been not transparent, for example, with respect to Safaricom, you've not been transparent in how you manage the PDL, the Petroleum Development Levy, for example, because we know money from that has been used for other purposes, right? Funding the nuclear program, subsidizing the National Oil Corporation, paying off debts to the Exim Bank of China. If that is a track record that you have, then it stands to reason that we're going to run into the exact same governance problems with the Sovereign Wealth Fund.
They'll even be worse because the Sovereign Wealth Fund has less scrutiny than the others. Actually, I mean, I think there are about 19 countries on the African continent, so it's not really an innovation, and not many of them have done well with sovereign wealth funds and the transparency around them. So you're just introducing new politics and the problems of politics back into the sovereign wealth funds. And if you look at the state corporations and their record in Kenya, terrible, terrible. So yes, unlike many people actually, a sovereign wealth fund for Kenya today, regardless of what government's economic advisors and the president himself argues, is a solution looking for a problem.
What about the National Infrastructure Fund? Because if, let's say, hypothetically, let's say they say, okay, fine, we agree with you, Kwame, we're not doing anything with the Sovereign Wealth Fund, we don't have the surplus capital for it, assuming, or maybe we'll do that with oil money when that starts to come in. But we have this $2 billion, let's put it into infrastructure. Would it make a difference? No. Especially, I'm especially suspicious because if you look at it, even the new one, the infrastructure development, I mean, on the PPP, well, outside the PPP between Kenya, between Nairobi and Naivasha and that, I mean, those terms as declared to me today are atrocious. They're terrible. It is not likely, in my view, that those the amount of traffic that is required to actually pay for itself will happen. So government is still on. Is still going to have to actually top up some of those. Because taxpayers will still have to fill in that gap.
Taxpayers are going to have to fill in that gap. So I don't think that that's necessarily a big deal. So it's the same problem that if you have problems with fiscal management, establishing new and more complex structures is just going to make them even more complicated.
Aren't we, in a larger sense of things, isn't the Kenyan government effectively creating a lot more undeclared, opaque contingent liabilities on the taxpayer? Because there's a whole bunch of these structures that have come in, right? You've securitized parts of the road maintenance levy.
Yes.
That's one. Here now we're saying, well, you know, if in the event that we do get into this PPP, we build an entirely new road, we don't know what the traffic triggers are, right? So at some point, that's an undeclared liability.
Precisely.
On top of that. If the Kenyan government then decides, well, we're going to get into the infrastructure program, and they say they're going to crowd in a lot more private capital. At some point, I mean, this is all a lot of undeclared debt, right? That's not making it into the books.
That's what it is, and it's clear that if you consider Kenya's, and it's contingent, right? So that means necessarily that it's the estimates of what its values would be are not very clear at this point. But if you look at what happened with the expressway, where in order to meet those payments, actually the cabinet secretary actually refused to approve. Right, toll numbers going up. It means that those liabilities are still being handled at the treasury level, or let me say through the fiscus. So that's just basically it. So I think it's just creating an instrument with many moving parts without asking ourselves. I mean, this thing is supposed to move us at this number of kilometers per hour. If it doesn't do that, what does it mean? So that's a fear. So you're hiding liabilities. Contingent liabilities are going to blow up. And one of the problems that the government of Kenya has had with the IMF programs are usually the contingent liabilities. Managing contingent liabilities has been a big fiscal problem, management problem for the government of Kenya.
Because those are the same arguments they ended up having about the G2G arrangement with oil imports.
Oil imports, yes. So I think there's an obsession with the technical agreements for its sake, but the fiscal implications are the government of Kenya will still bear liability if they fail to come through.